Okay. Hey, everybody. Ray Olmo, TRUST-CFO. Hope everybody had a fantastic Father's Day here in 2020, specifically with all this COVID stuff. It seems to be simmering down. It seems like a lot of people got together with their fathers and loved ones. We did that, and we had a great time. And I'm going to ask that question to my good buddy, Jeff Verdon. We have on, as we always do, for our weekly hot topic. And we have an awesome hot topic today. Jeff, how you doing today, buddy?
I am doing great, ready to go. It's Monday morning, fired up.
Right on. How was Ashley and Adam serving you like a king over the weekend?
I had my
Father's
one day a year where they actually were nice to me, and they gave me some beautiful cards and some gifts, and it was a great day.
Fantastic. Good to hear. Good to hear.
Yeah.
Well, as usual, what I talk to you weekly. We're on your sales meeting. Something has been coming up on a regular basis, and I wanted to take that as this week's or this current hot topic, and that's dealing with the topic of life insurance, and it's dealing with the strategy of financing of life insurance to solve our clients' needs. And the current economic environment has really kicked open the door for these solutions. I've been seeing you do it with our mutual clients. I've been involved in this heavily. We have a lot of very high net worth cases going on mutually. So I thought it prudent and it warrants a discussion, because every time you and I are talking to clients, they've never heard of it. They don't think into that depth of how to infuse and how to cash flow what are considered expenses, things like life insurance. So that said, do you have a specific intro that you would throw in terms of this topic in your experience?
Well, as an estate and trust lawyer for over 40 years, I deal with life insurance matters all the time. It's probably the most tax efficient, important asset class that we deal with. And yet there's a general dislike or people, when you bring up the topic of life insurance, it's like you're calling their kids ugly or something. And why is that? Well,
no one likes talking about mortality. That's a fact. But two certain things: death and taxes.
I think my relationship with the insurance business goes back as a kid. Both my parents were in it, so I had a chance to see them in that industry when I was young. I actually put myself through law school selling life insurance. I had to get a job after my first semester of law school, and got a job selling mortgage insurance for Transamerica, and they paid me $800 a month while they taught me how to sell insurance. So I've been around it my entire life. And what I can tell you, it's the one advisor that is probably the most important advisor who comes out to meet the widow or widower is the one that brings the death benefit check when the insurance policy pays off. But what I found over the years is people don't mind owning life insurance, Ray. They just hate to pay for it. I mean, why you pay for something that you don't get the benefit of until you die?
So let's talk about the quandary there. It's a weird dynamic. Is insurance people recognize as well? It's a great solution, because what I'm doing is I'm paying pennies on the dollar to solve a liquidity issue. We're going to talk about what those needs are on a mass scale. But so they understand the economics, but then when it comes to the pricing, again, it's, well, do I write a check today for solving a problem in the future, but I need the cash today? And that's the confluence or the issue that I see clients always wrestling with, right? It's a cash flow issue.
Well, my clients don't have cash flow issues. They're very wealthy people. They want to deploy their capital in the most efficient manner possible. I think for most people, the experience of buying a life insurance policy has not always been the best. I mean, it generally brings in a very high pressure, high power salesperson. It's complicated. They don't really understand what they're buying. And so they're relying upon the integrity and skills of the life insurance professional. And back in the old days, that was more treacherous than it is today. But it's still an industry that's complicated. Life insurance products have been designed to mirror the stock market, which I think has opened up a great many more customers to the insurance business than people who were just simply buying it for death benefit. But in my world, we're using life insurance to solve a number of problems and to create some other opportunities. The problems it's solving is, as you mentioned earlier, the liquidity problem. While most estates are not going to have an estate tax, at least until the year 2026, if you die on or before January 1st, 2026, the
Can
need
you
for
give
life.
us, sorry, Bob, can you give us those numbers real quick so people that are watching this understand what
Well,
we're
if right now, if you own property of $11,580,000 or less, you will not pay any estate. That's per person, and you die between now and January 1st, 2026, you will pay no estate tax. And so the need to buy life insurance to pay death taxes is somewhat abated until those dates are met. Now, depending upon who wins the election in November, those dates can get rolled back significantly because the Democrats feel that we've given the wealthy too many benefits, and they want to roll that back to a much lower exemption amount.
reminding everybody that under Obama reign, it was 3.5 million per spouse. So it went from 7 million to 23 million overnight, with Trump in office, right?
And for those who live in California, California tried to bring back the inheritance tax, which we haven't had since 1982, with an exemption of $3.5 million, but above that 40%. It didn't make it on the ballot this year, but I suspect it'll be on the next time it can come up. So we look for California to bring back the inheritance tax. They need the money. So life insurance traditionally has been to replace income of a breadwinner in case they were to die, provide education for the kids. In the business context, key man insurance, buy, sell, and then to pay estate taxes. But the estate tax liability for most people is not going to happen, at least for the next few years. But life insurance, the way that our clients tend to view it, is a way to create liquidity for the benefit of their kids and grandkids, so that the professionals can manage that liquidity, generate a higher rate of monthly income, and provide a greater monthly benefit for their kids and grandkids after they're gone without changing lifestyle. And to do that, before 1996, there was only one way to pay for your life insurance, and that was with writing a check. You can pay it annually, you can pay it quarterly, monthly, but you had to write a check. And in 1996, the concept of premium financing was born, which, in my estimation, completely revolutionized the way that large life insurance policies are sold in this country. Because just like buying real estate, you can finance your premium. And with today's low interest rate environment, you can finance your premiums at very, very low rates. So premium financing has become very popular, not because people can't afford the premiums. It's because they'd rather deploy their capital in other ways than giving it to the insurance company.
Well, that comes back to your concept a few minutes ago, or idea that the business owner wants to always look at how am I going to have the least cost to the greatest rate of return in capitalizing, creating wealth. And the factors right now, the variables, have opened up the door to create quite a spread in terms of arbitrage, right? So when you look at the averages that these index policies have been generating, I've been looking at some of the numbers for our clients, running analyses, and even if you run them extremely conservative, you have like 100% probability, at a 5.5%, crediting rate that's tax free, and yet your cost of money to go finance this is in the twos, right?
That's right. And what's surprising to me is how few people know about premium financing, even though it's been around about 25 years. I give speeches on cruise ships a couple times a year and at financial conferences. And when I ask the audience if they've ever heard of premium financing or the ability to finance their life insurance, maybe one hand in 10 go up that they've heard about it. So I think the industry has done a poor job in letting the public know that that there's alternative ways to pay for their life insurance. And I think the insurance industry themselves could do a better job in communicating that to the public.
Well, so some of the change has been, I think when you shared, it initially had come out because what the issue back then when it was, created, I guess, in 96, was you had these huge illiquid estates, like farmers, ranchers, and they've got real estate and they can't, they don't have the cash to go and pay for these premiums. So they had to lever their estate to be able to solve this huge estate tax problem back then. But the times have changed. 85% of all policies now are sold for retirement supplement. And the premium financing model has been reduced substantially, not just for the mega wealthy, but for solving other cash flow problems on a fairly reasonable level. Yeah, you're not going to do your $500 per month, term premium with this. You're going to do it when you're dealing with business owners and higher end concepts. That said, I'd like to tie that into your my world. The reason this has been coming about quite a bit is because you and I are the leaders in the private retirement plan segment. And, I'm preaching to the choir, Jeff, but when we're doing our designs, you specifically, in a vacuum, we're creating the need for the insurance to solve some of the problems, using private retirement plan. Yes, we're protecting a bunch of assets, but a client might fund like a promissory note that says, hey, I'm going to go and fund my future earnings, and I got this huge note. Well, I need to pay interest to that note, which protects the earnings. That gets jumped into the bucket, and now we can use those funds in a smarter way to go and solve more holistic problems. Your comments on that?
Well, I find life insurance to be an asset class that a wealthy family or a family with means can, always add to what they currently have. Take the real estate investor, the real estate developer. One of their needs is cash. They always need cash. They're always leveraging themselves. Well, imagine a real estate developer family that could leverage some of the cash flow on their properties and create a secondary asset class in their dynasty trust, so that the trustee who manages their assets for their kids and grandkids, when G1 passed away, when mom and dad passed away, would suddenly have, maybe tens of millions of dollars of cash to go out and buy real estate, to wait for opportunities where undervalued real estate was available, and then to go out and develop that real estate without always having to be at the behest of the banks. Well, they can set that up without changing their lifestyle by using the cash flow from their properties to leverage into a premium finance policy. And developers and real estate industry people like that because, as they know, cash is always the king. And if they have it available, then they can create significantly greater wealth for their legacy than not having it at all. So using life insurance to create additional assets and thereby create additional cash flow, I think, is a very important financial planning tool. One day there's $25 trillion of debt's going to have to, the tab's going to come due, Ray. And when it does, it's going to change the landscape, I believe, of how financial instruments are sold, how, the ability of people to maintain a lifestyle. And the more cash that the family can leave their kids and grandkids for the professionals to manage, the more cash flow and therefore the better lifestyle they can assure their descendants. And I think that's where life insurance can play a very vital role, and premium financing can make that happen versus cutting a check for the traditional premiums that we're used to seeing.
So let's really kind of pull in some unseen benefit on the premium financing schematic, which is, insurance in the state of California is not exempt. $13,975 per spouse. It's a joke.
You mean exempt from lawsuits?
Creditor exemption, correct. So people that are investing and buying regular policies, again, we found they have no clue that those assets are exposed. The myth is, oh, my insurance is protected, because it seems rational, but it's not. In the premium financing cases I've been working with you on, there's almost a dual fold asset protection benefit. You're the guru of asset protection. So at the end of the day, what happens is we can protect life insurance through premium financing because we have a bank basically securing and protecting the policy, right? And if we use like our private retirement plan strategy, we can even drop a dome over that environment, but they work really well together. So again, your perception on the asset protection benefits that you get from this type of design, a premium financing structure.
Well, the exemption is limited to $13,000, a little under $13,000 exemption from creditors and predators, but the death benefit doesn't have any exemption. What we're finding a lot is now that the $11.580 million exemption is turning people away from forming traditional ILITs, revocable life insurance trusts, and just having them hold the insurance individually. And when we're designing a private retirement plan to supplement our clients' retirement, and we're going to fund it with assets in kind, we notice they have life insurance policies which they own, which are in their names, And a lot of these policies have cash value that exceed the creditor exemption amount in California. So funding the policy into a private retirement plan, both to insulate the cash value and then eventually insulate the death benefit when the insured dies from future creditors and predators, is a really important planning tool that not enough advisors are really focused on.
Yeah, and we're on a mission where we're going to be educating quite a bit of people, our referring advisors on this topic, because again, they're probably not privy to the now new open environment with the change in interest rates and things like that. It's really created opportunities. And wrapping up, the conclusion is if any one of our clients, or advisors, needs to understand the three-dimensional thinking on higher end advanced planning for insurances, you should check in with Jeff Verdon, TRUST-CFO. We work as a team. Jeff, on the last note, you have a video on the subject on your website. Can you give us that address real quick?
Yeah, www.jmvlaw, Jeff Mike Victor Law.com. And the premium financing video is very instructional in terms of what it can do. And then when you combine it with certain types of dynastic trust planning, like our HISET trust, where you can transfer income producing assets out of the estate to take advantage of the current high exemption amounts, and then use the cash flow in that trust to purchase life insurance on mom and dad, or mom or dad, at their death, leaving substantial death benefit for the trustees to manage. But while mom and dad are alive, the policy is building up significant cash value, which can be withdrawn from the policy income tax free, and then loaned back to mom and dad as a loan, which they can then access to supplement their retirement income tax free. And when they die, whatever they owe the trust from those loans would be a deduction against their gross estate, lowering their estate taxes. So it really is a nice, nifty, simple planning strategy when you combine dynasty trust planning with premium financing. And we have articles and videos and models on that on our website.
That's great. I'm gonna finish this up with a layman's synopsis. I've had a lot of clients go, well, I don't know that I quite get it. And I said, okay, let's picture this. You need liquidity. You need $1 to solve a very complex problem in the future. Okay, but you want to focus on keeping your cash. Insurance is taking pennies on the dollar to create the dollar. What you're going to do now is you're going to borrow those pennies and you're going to create the dollar and solve your problem. And then when you die, that dollar then pays back the pennies that you borrowed. So all tax free. And my clients tend to get that very simple model. Oh, it's leverage on leverage. So again, at the end of the day, there's education that's needed, but it is definitely an application that, I've appreciated your education, some of your peers, Julian Mavason is a good buddy of yours. You guys have been doing this for eons. I've been involved, and it's now coming back full force. So again, hopefully our listeners get some, quick insights, and we're there to help. So thanks, Jeff. Always great to have you and these hot topics, and we'll probably see you next week on another one.
All right, Ray. Thanks, buddy.
Thanks, man.
Take
Bye.
care. Be safe.